Imagine this. A small group of people gathers in a quiet room, talks for a few minutes, and suddenly the stock market jumps. The US dollar rises or falls, and investors worldwide start cheering or panicking. They don't pass new laws, they don't run for office, yet their choices affect your paycheck, your savings, and even the cost of your morning coffee. That group is the Federal Reserve, better known as the Fed. Whether you notice it or not, its power stretches from Wall Street to your daily life. But how did it get so powerful? And why does its influence reach far beyond America? The birth of a giant. The Federal Reserve was born in 1913, after the U.S. went through repeated financial crises. Back then, banks were failing, people were losing their savings, and trust in the system was falling apart. To fix this, the Fed was created as a lender of last resort, a safety net to bring stability during economic panic. What started as a simple safeguard has since grown into the most powerful central bank in the world: the power to create money. The Fed has one ability that makes it unique. It can create money. With just a few keystrokes, billions or even trillions of dollars can enter the financial system. This power allows the Fed to control inflation, guide interest rates, and decide how much money flows through the economy. Think of it as the Fed holding the remote control of the financial world. When it presses play, pause, or rewind, everyone else, from small businesses to governments, has to adjust. Interest rates, the hidden force. Whenever you borrow money, whether it's for a car, a home, or just using a credit card, the Fed has already influenced the cost. That's because it sets the benchmark interest rate. When the Fed raises rates, borrowing becomes more expensive, businesses slow down, and the economy cools. When it lowers rates, loans become cheaper, spending grows, and businesses expand. These decisions may seem small, but they quietly shape the rhythm of daily economic life. The Fed's global impact. Here's the surprising part. The Fed's influence doesn't stop at America's borders. The US dollar is the world's most important currency. Oil, gold, and most international trade are priced in dollars. So when the Fed changes its policies, like raising interest rates, other countries often feel the shock. Their currencies can weaken, their borrowing costs rise, and their economies shift. In many ways, the Fed isn't just America's central bank, it's the world's crisis manager and market mover. In times of crisis, the Fed steps in with massive action. During the 2008 financial meltdown, and again during the 2020 pandemic, it created trillions of dollars to stabilize markets. It bought government bonds, bailed out banks, and injected money into the system to prevent collapse. These moves worked, but they also show just how powerful the Fed really is. Today, a single sentence from a Fed official about future rate hikes can send global stock markets soaring or crashing within minutes. The debate over power. Of course, such influence comes with controversy. Critics argue that the Fed's ability to print money and control rates can create dangerous bubbles, favor Wall Street over everyday people, and increase inequality. Others point out that the Fed is not elected by the public, yet its decisions affect millions of lives. That's why some call it the most powerful unelected institution in the world. So why does the Federal Reserve have so much power? Because it sits at the very center of the global financial system, controlling the flow of money, the cost of credit, and the trust of markets. Its influence is so strong that a whisper from the Fed can change the course of economies around the world. But the bigger question remains: is the Fed's power used for the good of the people, or mainly for the system itself? That debate is likely to continue for decades. One thing is certain, though: whether you're buying groceries, paying off a loan, or planning your future, the Fed's invisible hand is always there, quietly shaping the outcome.